Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to Chart This. And apologies if you got the first just absolutely messed up stream. I don't know how I did that. That is a first in the brief history of Chart This with Dave Keller, which I managed to put myself in the same live stream twice. I think the magic of AI here in August 2025 allowed me to create two versions of myself. I had an echo. I had multiple camera shots. That was crazy. That was a fun one. So I'm looking over at this thinking like, I don't know how I did that. I don't know how to fix it. So I just pulled the plug. I hit the red panic button. I completely started over. So I apologize if you were just getting over from the other failed live stream. Hey, this is how you know it is actually live and coming to you from Redmond, Washington. So with that in mind, welcome to the show. Apologies for the crazy intro, but thank you for joining me here today. We're coming to you from a beautiful, it's kind of, boy, it feels like a fall day or a spring day here in Redmond, Washington. It's a high around 62. Beautiful day here. And I wish you guys are all doing well and hanging in there wherever you're tuning in from. Kind of a crazy market environment as well. We opened higher, we traded lower through the afternoon, but then a nice rally going into the close. So first 30 minutes, higher open, weaker trade. The last hour, very strong. Not enough to put the S&P 500 in the positive, although the NASDAQ did finish slightly higher. The contours of the day, as I'll show you here in a minute, pretty remarkable. With that in mind, we're going to talk about some of the different themes that we're observing here. Breadth conditions, still technically okay, but we'll update you on some of the charts that we're reviewing. Sentiment data getting a little more overheated, and you'll see the name exposure index back to pretty bullish, which suggests that money managers in that survey getting back into the markets here in the last week after a series of sort of lightening up on an equity position. A lot of charts to review, a lot of gaps to the upside and a couple to the downside. I've got one to share with you in particular. But with that in mind, let's go to the market recap here. Market overview, big gap higher at the open, right? So the S&P opened just above 60, we'll call it 63.85. So there's this kind of V-shaped, U-shaped shape to the day today. Big higher open, weaker transition. The Dow even more significant, just kind of falling off a cliff, right? Higher open and then just completely selling off into that initial strength. The Dow actually finished about 0.5% below Wednesday's close. The S&P 500 almost made it back to the green, closing around 63.40. And then the NASDAQ actually managing to pound out a positive day after selling off through the afternoon. So there's your leadership. Growth over value generally, although you see the top performing sector, kind of new growth, right? Utilities, the new growth engine of 2025 here with the remarkable energy requirements of AI are causing utilities to trade very much in a position of strength here. Mid caps and small caps both slightly lower today. And again, both of those opened very strong. And then again, big story of the today was the initial sell-off out of the open. This reminds me, by the way, there's a technique called the opening range. I don't talk about it a lot because I'm not a day trader, as I'm sure you've picked up on by now. But I do, I am familiar with tools and techniques that my day trader brethren would use. And the opening range is the idea that you look at the first 30 minutes, right? And you sort of set the high and the low for that first 30 minutes. And then you see which way we break out of that opening range. And if we break out of that initial 30-minute range to the upside, that usually means the day is going to be pretty strong. If we break below the 30-minute range to the downside, that means the day is going to be generally weak. And this is one of those where the opening range is a pretty good indicator because, on mid caps, for example, soon after 10 a.m. Eastern, we break right below that lower threshold. And that just tells you there's enough selling coming out of that first 30 minutes. You probably want to be more defensive. And that was generally the right way to play the day today. VIX, even with all that movement, the VIX actually ended up finishing right around 1650. That's not too far from where we were yesterday after the close. We can see the VIX opening was closer to 16. It did get up to around 1760 in the afternoon as the markets were selling off, but that rally, coinciding with a lightening of volatility. All right, looking at the rate environment, you can see that interest rates generally moved higher. The 10-year yield finishes the day around 4.25. The long bond yield just above 4.8%. That's not much of a change from yesterday. And the 5-year point just below 3.8%. That's up a decent amount from yesterday's close. So bonds generally kind of rotated lower. The dollar index honestly almost unchanged, although it was a choppy session. Ended up selling off into the close and ended up not too far from where we started. That was using the UUP ETF. Looking at the commodity space, gold and silver, precious metals pushing higher today. The GLD closing just above 313. That's at the highs of the day. Silver even better. And I'm pointing these out in particular because I just interviewed Jeff Huge on my podcast earlier this week. We just released that episode earlier today. I would encourage you to check that out. It was a really good discussion. I've known Jeff for many years. I followed his work in a number of different setups that he's had. And he edits a newsletter called Huge Insights, which I absolutely love the name of that newsletter. Jeff is a big Elliott wave aficionado, uses that to talk about some downside targets for the S&P, given more deterioration to come. But what I loved about our discussion in particular was we talked about performance year to date. And a lot of people are surprised to realize how much gold and silver have outperformed the NASDAQ in 2025. So many people have been talking about AI, about mega cap growth stocks. There are a lot of things that are actually up a lot more than the NASDAQ 100, and gold and silver are perfect examples of that. So we talked about that, talked about cryptocurrencies, talked about other things, and then also about growth stocks and about the S&P. But I would encourage you to check out that interview. And again, I've never been afraid to talk to people who have incredibly high expectations to the upside with aggressive upside targets. I'm thinking of like a Craig Johnson or Ryan Dietrich, who I've had on my show before, who often are fairly constructive and have bullish targets that seem unreasonable at times. And I'm also not afraid to talk to people that have aggressive downside targets. And Jeff, as you'll see, has a pretty aggressive downside target in mind for the S&P 500. I think of market analysis when you're talking to someone like that, it's to stretch your thinking and to get you out of your comfort zone and to force you to critically consider your own biases and your own approach. And for that, I'm super thankful for those conversations. And I hope you find that they stretch your thinking a little bit as well. Crude oil not having a great day. Energy prices generally moved lower. Looking at cryptocurrencies, though, pretty strong. You can see Bitcoin actually pushing to the upside, currently above 117,000. That just happened during the equity trading session. Ether prices pushing to the upside as well, getting closer and closer to that 4,000 level. And the rest of the top 10 coins all in the green today. Looking at the sector rotation, kind of split 50-50 between sectors higher and lower. Utilities, as I mentioned, kind of the new growth sector for the markets in 2020, 2025. And that really, that's really driven by the incredible energy needs of AI, generative AI, and crypto mining, and all these things just require a ton of energy. So these utility companies are expanding aggressively to try to address those energy needs. And so the stocks are trading more like growth stocks here. Utilities up 1.1% today. Consumer staples number 2, up 0.8%. Materials number 3 after struggling yesterday. On the downside, you have healthcare down 1.2%. I'm finding lots of charts in the healthcare sector that look underwhelming at the moment. Although there's some random ones that are starting to pop higher, but still a tough sector on a relative basis. Financials number 2. The relative performance of financials also struggling here in the last month or so. And then communication services, 3rd from the bottom. Looking at breadth conditions, we can see kind of a neutral day, I would say, more than anything. You can see on the New York Composite Index, almost evenly split between advancers and decliners. Decliners somewhat outnumbering advancers, but not by much. And the same with the S&P, basically flat. Breadth on the NASDAQ, not quite as positive, but I've learned to ignore breadth on the NASDAQ composite for quite some time. On yesterday's episode, we talked about a chart that Walter Deemer had recently shared and why breadth on the NASDAQ composite index often skews negative. And it's just because of a lot of the crappy stocks that are listed on the NASDAQ that just kind of skew the breadth to the downside. Go listen to yesterday's show if you want to learn more about what I just mentioned. So generally, I would say the breadth was not overwhelmingly bad, but it was certainly not good. This was not a good breadth day by any stretch. Finally, we can see the Magnificent Seven and Friends, these leading growth names. Apple up 3.2%. I mean, Apple really, really close to a significant breakout, arguably breaking above 215 today is pretty impressive, right? Gapping higher above that previous resistance. This is where the stock stalled out through the month of July, and over the last week, going into yesterday's session, had continued to roll over. Yesterday, big announcement from the White House about Apple producing or making a big additional investment here in the U.S. Popping today, gapping higher yet again. So 215, I think previous resistance becomes support. That's a technical concept called polarity, where levels have meaning on the upside and the downside. So 215, that's kind of that short-term level I would be watching. I don't have a notepad nearby, but I'll write that down. I'll try to remember that for later. NVIDIA and Tesla both up about 0.75% to round out the top three here. Meta and Microsoft, though, both going down here. And again, these are still good charts. But if there's something that I'm keeping in mind, and one of the questions I got on the YouTube channel yesterday, because as a reminder, tomorrow will be our last show in the month of August. We're going to take the next 3 weeks off to rethink all sorts of things about market misbehavior, my firm Sierra Alpha Research, and where I'm focusing my time and attention. But I'm going to take some time off, taking my family to Ireland, taking some time off that way, moving my daughter to boarding school in Michigan. There's a lot happening for the Keller family. But I'm going to be taking this as an opportunity to sort of just rethink about where I'm at and where I'm focused and what I think is most helpful. And I would say one of the questions was, what charts do I want to leave you with as like key charts to watch? And we're going to talk about that on tomorrow's episode. But as a preview, I'm pretty sure Microsoft and Meta are probably going to be on the top of that list because, Meta's not a bad chart. It's a very good chart. And again, in the last week, it's made a new all-time high yet again, pushing above $780 a share. But I can't help but notice that a leading company, Meta, with arguably the most optimistic or the most encouraging earnings release you could come up with last week, right? That's all good. And that gap higher that we had after their earnings date, that's it. We haven't gotten any higher. So if you're all bulled up because of Meta's amazing earnings, like I get it because it gapped higher, but keep in mind through today's close, that gap higher has been it. We have not gone above that level. And so I think when great companies report great earnings and then don't go much higher, that tells you a lot about the risk appetite right now and the fact that the risk appetite is very, very low. I would say the same thing probably at the top of my mind for Microsoft, right? There's Microsoft with their incredible earnings, talking all about Azure and cloud computing. And it's like, this can't go anywhere but up. That open after their Wednesday report last week, that's Thursday's open. And that we haven't even gotten anywhere near that since then. And in the week since that opening gap higher, all we've done is gone lower, and we've completely filled that gap from that earnings date. So for Meta and Microsoft gapping higher but trading lower, I would say out of all the things I would tell you about, and we'll fill in the gap with fill in that with other charts that I'll leave you with that I think are important to watch here over the next couple of weeks. But Meta and Microsoft certainly are top of mind for me. And again, today going down again. So it's not that these are bad companies; they're great companies. I mean, it's hard to deny that they're exceptionally good companies with amazing footprints in the consumer, in the corporate space, in cloud computing, in AI. But great companies don't necessarily make great stocks today, right? It's all about what the opportunity is going forward. And what those charts are telling me is that now is not the time when investors are bidding those stocks higher because of optimism. That's more of a glass half empty. They've already run a ton and we're taking profits. That's what the chart is telling me is happening over the last week. More to come for sure. And tomorrow on the show, we'll answer some questions from the mailbag. And one of the most important questions, what charts will I leave you with here for the next couple of weeks? I'll give you some good ones, I promise, tomorrow. All right, with that in mind, let's look at the market carpet. I do see some questions coming in on Facebook, on LinkedIn, on YouTube, and X. I appreciate supportive words about taking time off. I'm a huge fan of doing so. I appreciate comments about well wishes, and I appreciate for that as well. And I look forward to circling back with you. By the way, I did promise my premium members I would stay very plugged in. I would be answering questions, sharing some market updates there. I have to limit my focus and just sort of, trim some things and focus my attention while I'm going to be away. So perfect time to join as a Market Misbehavior Premium member. You can find out more information at marketmisbehavior.com/premium. Make sure you use the code YouTube if you check out, because you'll get 30% off your first 12 months on any of those plans. So check it out, and I'll look forward to keeping in touch with you a little more closely there if you're a premium member. For now, though, looking at the heat map, very much mixed. I mean, Eli Lilly, some of these names are gapping lower pretty aggressively today. And so there's sort of one-off things happening. Eli Lilly actually making a new 52-week low this week. So that's not good. In the technology sector, right, Apple's amazing gap higher aside, AMD bouncing higher, making arguably what could be described as a bull flag pattern here. Uber rotating higher after a bit of a pullback. The outside of some of the semiconductors bouncing off of weak levels, I'm seeing a lot of red here. CrowdStrike, Palo Alto. I mean, these are all stocks that have been, kind of rotating to the downside. Intel in the news pretty seriously. Salesforce rotating back lower. So there are a bunch of technology names today in particular starting to rotate lower kind of aggressively. Other takeaways looking at a high level here at the heat map. I mean, financials really struggling. And the relative performance in financials has not been particularly good, right? If we look at the XLF and you look at their relative performance. So, here we're looking at the price of the XLF, we're looking at the momentum, and then we're looking at the relative strength. I mean, from the April market low, the XLF has gone up, but on a relative basis, look at what this has done. Look at what this has been for you on a relative basis, right? Owning financials for the last couple months, you've been underperforming. This is why relative strength is such an important part of my toolkit. If you just catch yourself looking at absolute price returns, you can get lulled into a false sense of optimism because you buy something at 42 and you still own it at 52. And that seems really, really good. The problem is other stocks have done much, much better. The major benchmarks have done much better, to say nothing of things like gold and silver and Bitcoin ETFs and so many other things that have gone up way more than financials. That's the danger in a bull market of just like finding things that are going up and ignoring that your relative performance is what you should be focusing on, because things that underperforming in a bull market just means you're not doing as well as just a passive product. So why are you actively managing that position if you're not paying attention to their relative strength? That line has saved, arguably been the most important thing that I've looked at over the course of my career, because it's helped me stick to things in down markets that are holding up better, that are going down less than the benchmarks that are struggling. But it's also helped me in this kind of environment to recognize strength and to recognize where the opportunities truly are. And so this sort of move today, where you see the financial sector struggling, is just the latest period of, just sort of puts an exclamation point on the underperformance that we've seen. I talked about, unwinding a position in Berkshire Hathaway after it's breaking down. But I would say you can see similar things like in the chart of Visa. Visa could end up being a really good stock, but today we're closing below the 200-day moving average for the first time since last August. It's been a year since we've been below the 200-day moving average, but that's kind of where we're at here. Now, we could bounce off the 200-day and rally, and that's great. I'm happy waiting for that sign of accumulation, but I'm not seeing signs of accumulation in trend because we're making new 3-month lows. I'm not seeing it in momentum where the RSI is pushing below 40 here. And I'm definitely not seeing on relative strength where the stock has been underperforming here for the last couple months. So the heat map really quite mixed today, I would say. If there's one thing I will tell you is using visualizations like this to help you identify strength and identify weakness and focus in any environment on what's getting it done relative to others is a super, super valuable part of the technical toolkit. Heat maps like this, I would say, are brilliant ways of summarizing the technical conditions in a bunch of names in an easily digestible format, helping you get the big picture down to the micro picture. So I hope you take advantage of tools and techniques like that going forward for sure. All right, let's continue on here looking at some charts. Again, please put your questions if you're tuning in live on our live stream. We'll grab a question or two at the end. We will answer some more questions on our mailbag episode tomorrow on Friday, August 8th. For now, though, the S&P is still in decent shape. I will continue to say the S&P is in decent shape as long as the S&P holds 6,200. If and when that would fail, and if we fail to hold the 50-day moving average, that's where I think you need to really start thinking more defensively and thinking about further downside targets and what that might mean. And again, in this sort of environment, I hear a lot of people giving the long-term bullish thesis, and it's not wrong. I mean, generally speaking, corrections are very, very normal. Generally speaking, in a bull market phase, you're going to get, prices pulling back, in some cases, significant amounts. Generally, those are good times to buy, right? You buying when the market has had a period of weakness is a tried and true way of playing the long-term bull thesis in stocks. But the question I would ask is, do you really want to ride the market down from 63.40 to like 5,900 or 5,400? I would not. I would much rather be defensive during that position and outperform during that period, and then find an opportunity to get back in later. And that's why, seeing red flags that have me concerned tells me, all right, I maybe want to start thinking more defensively. And for me, breaking below 6,200 would unlock that particular line of thinking in my own portfolios for sure. All right, looking at the breadth indicators, stocks above their 200-day still very, very good, above 57, but right around 57%. Stocks above their 50-day, great, above 50%. Those things break below 50%. I think that's pretty bad. For now, it's still good. So again, what this means is about half of the S&P 500 members are below their 50-day moving average. So there are plenty of stocks that either have been going down for a while or are just starting to break down here in the last month or two. But I think as long as that holds 50%, things are still generally okay. This indicator starting to break below 50% has often been a really good early warning that we're at the end of a bullish phase. The name exposure index, just to update you on two breadth indicators. Actually, there should be one more chart on here. I think I fixed that one. There should be a chart. There it is. The AAII survey, two sentiment indicators that we follow every week. This is the AAII survey, American Association of Individual Investors. Basically, you're asked, are you bullish, bearish, or neutral on stocks? And they track the weekly data. I've been following this survey for many, many years, which is one of the reasons why I find it so helpful, because you can think back and look back to previous bullish and bearish cycles and see how investors have tended to behave around these periods. Big kind of downward turn to this data this week. Last week, bulls outnumbered bears by about an 8% gap. This week, it's the flip that script. So now an 8% gap of bears outnumbering bulls. The bearish reading increased to around 43%. The bullish reading decreased from about 40% to 35%. So we're seeing less bulls. We're seeing much more bears. And this is a big switch in that sentiment data from last week. The name exposure index, though, almost the opposite. We can see that last week, money managers in this survey, only about a 76% allocation to equities on average. This week, about 20% higher, around 96%. So a big gap higher, one of the biggest changes I've seen in that survey in quite some time. That implies that money managers are actually getting into the market after that pullback that we experienced last week. So sort of a mixed bag of sentiment data. Individual investors getting less optimistic, money managers in the name exposure index getting a little bit more optimistic, given the environment that we've seen. For me, one of the things that has often been one of the most important signals has been this indicator getting above 100%. That's often indicated in a market that's kind of overextended, as investors are getting too optimistic. So if that would happen here in the next week or two, that would be a pretty bearish sign, based on my assessment. I mentioned the chart of silver, and again, I would encourage you to catch the interview with Jeff Huge. Really, really great charts, interesting, thought-provoking discussion. I hope that you will appreciate. The chart of the SLV for now in pretty good shape. We're back above the 21-day EMA. We just bounced off the 50-day moving average about a week ago and rotating back in a position of strength. The relative performance off the April lows, as much as we've been talking about how stocks have been strong off of that April low, silver's done very, very well. Here at the bottom, we're actually looking at the relative performance of silver to gold. We call the silver to gold ratio. And so when silver outperforms gold, that's actually usually a pretty bullish sign, because gold is thought of as a pretty traditional safe haven. So keep an eye for if and when that ratio would start to turn lower. For now, it's continue to favor silver over gold. All right, three charts to leave you with, and then we'll take a question or two. One's Fortinet, right? We mentioned some of the stocks in the technology sector rotating lower. Fortinet actually got had a big drop after reporting earnings yesterday. The stock down about 22% today. It is technically a hammer candle, right, where you have the open and close near the highs of the day, a long lower shadow. The stock got all the way down to 70 before rallying up to close just above 75%. So what do you do in this environment, right? I mean, so generally, I don't have a position in Fortinet. I would say this is one of the reasons why breaking below the 200-day moving average for me is usually a really good time to reconsider a position because, often bad things can happen afterwards, and that's something we saw today going into earnings. However, if you're looking at this name and thinking opportunistically, what I look for personally in a chart like this is a sign of accumulation, right? Gapping lower is bad. That means we have revalued this stock to the downside aggressively because of what we learned with yesterday's earnings report. So what comes next, right? So you often have, you basically have two different things that tend to happen. One would be a gap and run, right? A gap lower and then a big rotation higher. The hammer candle today implies that that might be a potential outcome, in which case I would be using something like Fibonacci retracement. So here, the August low to the February peak, we can see 61.8% of the way down is around 77.50. So I might put a speculative position. I wouldn't disagree with taking a flyer on a stock like this that's gapped down so much. But for me, waiting for a bit of a breakout, which would suggest there's starting to be signs of accumulation, that would be important to me. Otherwise, I'd probably be avoiding it because the gap lower is enough to tell me that investors are pretty cold on this stock. So I look for a warming. I look for very cold sentiment to rotate to a little warmer sentiment. Indicators that capture accumulation, looking for signs of improvement would be helpful. Breaking above that level around 77.50 for me might be enough to tell me things are improving, or at least there's enough buying off of that gap lower. The regional banking ETF, KRE is the ticker. Shout out to my good friend Miss Schneider, who I've interviewed many times and whose views and expertise I've really come to appreciate, and I consider a friend as well. She's just a warm and thoughtful person, and I appreciate her and her husband Keith's efforts to educate investors using technical analysis. She actually shared this a version of this chart on social media that I wanted to share with you. Regional banking ETF breaking down here, and that could be a concern. That's actually one of Mish's calls it her economic modern family, some key ETFs that she tracks to kind of key pillars of the economy that help you understand the dynamics of what's happening here. Regional banks looked really encouraging June into July as the KRE broke above the 200-day, broke above the May and June highs. From there, though, we stalled out at the February peak around 64 and now rotating back lower. I think the KRE below the 200-day moving average, pretty underwhelming. The relative strength has been weak. I think this is a chart more negative than positive at this point. If we can bounce off of the 200-day, it could be interesting. But for now, I'm expecting more further deterioration. So what's starting to work? I'm a big fan of things that are breaking out after consolidating. Viatris, VTRS, is one that may just be on the precipice of doing so. If you look at the November high around 13.50, look at the April low, all the way down just below $7 a share. We spiked higher. That initial April rally took us right to the 38.2% retracement of that sell-off going into the April low. And now we can see a number of times where we've tested that resistance. This is the kind of chart I really like to work with because you have a clear resistance level. And for me, I'm happy being super patient and waiting for that breakout above that resistance level. So I'm looking for a break above 950, which would complete a rotation above that Fibonacci level and above the May and July peaks. That's where we traded today. Not quite enough to get that trigger, but that's where I would set an alert on something like VTRS to see if there's enough upside follow through on the chart. All right, shall we take a look at a chart or two? Ruben, thank you so much, my friend, as always, for watching on YouTube. You said PGY is showing a bearish engulfing pattern. Should I sell? So to be clear, as always, full disclaimer, I'm not recommending you do anything. I hope you can do your own work. Talk to a financial professional. This is for educational purposes only, et cetera, et cetera. With that in mind, what would I do looking at this chart? So this isn't really a bearish engulfing pattern in the classical sense. So a classical bearish engulfing pattern would be an up day, then a down day, right? So day one is up, day two is down. And that's important because that tells you that the stocks in one day, day one is an accumulation day, day two, a big distribution day, higher open, lower close. And you're not really seeing that. You're actually seeing two big down days in a row. Today, we just had a higher open and a lower close. So I wouldn't consider that a bearish engulfing pattern. Things that concern me about this chart, the higher open and lower close, forget about what you call it candle pattern wise. That's not good, right? And the fact that we traded all the way up here above 40 before closing back near the lows of the day, that tells you a lot about what investors were doing, what traders were doing with the stock during the day. And it's not good, right? If we're all bullish and buying PGY, the stock closes up above 40 in that scenario. That's not what we saw today. The other thing is this is also showing some really classic divergences of higher highs in price and lower peaks in momentum. So what you have to remember, there's two kind of different parts of the technical toolkit. And if you caught my interview on the Investing with IBD podcast, that was yesterday, I spoke with Justin Nielsen there, had a really good conversation about a lot of different charty things and market outlooks and other stuff. But we talked about the technical toolkit. Part of it is a leading indicators. The other part are more lagging indicators. And I'm a big fan of using a little of both. Things that are classic leading indicators, bearish candle patterns, bearish divergences, volume rotations, because those tend to happen while the price is still going up, right? So prices are we're still making a new all-time high today, or a new 52-week high, at least today, on PGY. So the trend is still up in terms of the classic sense of trend following, but we're seeing bearish divergences, bearish kind of rotations, these sorts of leading indicators that imply that we're at an exhaustion point. So I think those things I'm now seeing. So the question is, what do you do about it? So I think you can be more aggressive and start selling or shorting already, saying, all right, I'm seeing enough signs of potential exhaustion. I'm willing to take a shot that exhaustion actually plays out with downside movements. Or you wait for lagging indicators. And that's what I personally tend to do. What I've seen so far in a chart like this kind of puts it on a watch list of, okay, we've had the run. We're seeing some signs of weakness. Now, does that actually play out with weaker price action? Now, things that are more in the lagging indicator camp, using the 21-day EMA and seeing if that holds. That actually held a week ago. Does it hold if we get further deterioration? The RSI's diverge. Does the RSI break down, get below 50, even below 40? Does the relative strength rotate lower? If I apply Fibonacci retracements, do we break some of those? So now what I would do with a chart like this is lean more on the lagging indicator parts and see if the signs of weakness that you're inferring actually play out with the stock rotating lower. For me, balancing the leading indicators and the lagging indicators, a very powerful way of anticipating turns, but also validating or confirming those turns as well. Great question, as always, and I appreciate some of the other questions. We'll put those in the mailbag and hopefully get to them on tomorrow's episode. But for now, I will say thank you all so much for joining me on the show today. We will do a show tomorrow on Friday, August 8th, answering some of our recent questions. I will leave you for the month of August with some charts I will be watching that I would encourage you to do as well. Please consider our premium memberships. One thing I am definitely thinking about is devoting more of my time and attention to the premium membership, making that a meaningful, investment for my premium members and make sure that I give them the attention they need. Check that out at marketmisbehavior.com/premium. Don't forget to use the code YouTube if you do take a shot at it, and you'll get 30% off your first year. But for now, I'll say have a wonderful evening. Thanks so much for joining me today. And remember, it's always a good time to own good charts. Have a good night, folks.